Welcome to both of you. Bill, I just want to start with you and Berkshire's earnings from its T-bill holdings. Apple's share performance, better results at Geico also helping.
Yeah, I mean, I think when you strip out, just set aside the investment results are obviously really important over the long run, but in the short run, you want to look at how their operating businesses are doing. And thanks to particularly the insurance side and what you mentioned, the income coming off the T-bills, operating earnings per share grew at about 8%. And when you kind of put it into perspective relative to the fact that the S&P 500, as a whole, is probably going to report a decline of more than 5% year over year in earnings. So a big divergence with Berkshire there.
Bill, what are your thoughts? I mean, if I asked you about stocks broadly, on that 7-month run we just mentioned, what would you do right now? Or would you T-bill and chill?
I think I would take a little, page from the Oracle and look for opportunities, because that's always the way he is, because it doesn't hurt you, right, to sit in T-bills a little bit. You do want to get in stocks over the long run, so I certainly would stay on the more defensive side. What you did see, or what we know so far, is Berkshire Hathaway was a net seller of about $8 billion in stocks in the second quarter.
True.
We'll find out next Monday what stocks those were.
Right. No, that's a great point, that they're selling, and they're, some of the most well-known equity investors of all time. Brian, let me turn to you. Maybe we can put that table back up. I see 1-year T-bills at almost 5.5%. Yeah. And I'm salivating. I'm like, back up what am I missing? Why, if I hold this to maturity, am I really going to look back and go, gee, I could have gotten 6.3%?
And if you do, you can put some more money into it, right? I mean, no one has all their money in T-bills, I hope. So I think you're right. I mean, that T-bill rate is very attractive. And what we've seen in fixed income this year, it was supposed to be the year of the bond, right? And that, I think, meant the equities couldn't go up 10, 20, 30, 40%. So it can't be the year of the bond. But certainly cash has done its job. I think what you're seeing investors doing is just what you said. Give me that cash rate and something riskier, but the stuff in between, I'm not sure that's high enough rate.
Yeah, I don't know if the 10-year is that attractive.
I'm not sure it's there.
The 30-year, but again, I look at it and I go, if I'm holding it to maturity, look, you don't want to be in a fund where you can all of a sudden be down 20%. But if I'm holding it till maturity, is the opportunity cost, okay, so the market, but this is where the stock market has been so frustrating, because you'd say, well, okay, Kelly, let's take the last 6 months. You could have 2.75%, or you could have, what has it been, a 20% run in the S&P 500?
No doubt. When you look, again, if we could crystal ball and say things are up 20%, you wouldn't need cash, right? It's not really the way it works. So, yes, people have buyer's remorse. They wish they would have bought more of the 7 stocks that were up the most. But I think if you take a real balanced view, cash is great. Money market funds have seen the inflows, right? So those cash rates are attracting investors, and they should. And then what you said, right? Listen, high yield and bank loans have also, done a good job. They've beaten cash, more risk, but you got a higher yield. It's that stuff in the middle where last week was an interesting week, right? We talked about the Fitch downgrade, we talked about deficits. None of it's new. But the question I think investors are asking is, if equities can still have a return, and I know my cash is good, I know credit's good, don't I need more of a premium for things like 10-year notes? And I think we have that question still out there to be answered.
One more question is, how much of these high yields on the short end, which Berkshire is benefiting from, they're one of the biggest creditors now of the U.S. government, but how much of the T-bill yields in particular are a result of the Treasury supply? Right now they're flooding the market with T-bills, as I understand it, in order to kind of drain money from the reserve reserves, things like that. They're going to shift that towards the longer end. How much do you think that's going to change yields across the curve?
Listen, I think the answer is not as much as people want to make it sound, right? The truth is the T-bill yield is there because that's where Fed funds rate is going to be. That is pretty fungible. More or less, it matters a little bit, but that rate is really where Fed funds is going to be. I think the question for out the curve is not necessarily on supply, but if you're going to have a lot more fiscal spending, right? If you're going to have equities that do okay, growth and inflation are going to continue to be high, then investors are going to want a higher return out the yield curve. Supply matters a little bit, but we're not going to sell off simply because go look at Japan, right? Lots of supply, very low yields. Less central bank buying. In fact, central bank balance sheets are shrinking, sticky inflation, cheap cash rates, resilient equities. I think it makes it tougher for the belly of the yield curve to have yields that are really low.
Bill, I'll give you the final question then. When you look at the markets, broadly speaking, where do you see the most opportunity, or the place that you'd most like to be right now?
I think I'd lean a little bit, again, toward the more defensive side. You've seen it today. the opposite of that, where the industrials are trading really well. I think the market's priced in a lot of good news on the economy, and probably in some respects rightly so. We are clearly further away from a recession than most people thought at this point. But I still think maybe there's some opportunity in, the healthcare area to just kind of lean against it, collect some nice dividends, and live to fight another day if, in fact, we do get a sell-off.
Yeah, it's like the pros are still they're a little nervous, not fully convinced by this one, I feel. Guys, we'll leave it there. Thank you both, Bill Stone, Brian Weinstein.
Thank you.
Appreciate your time today.